Hello, everyone, and welcome to this month's webinar, Building Blocks to a Successful Year. So being 19 days into 2021, we've already had some challenges this year. So wanted to bring together really three high-level ideas and high-level things to focus on to make sure that you have a successful year this year. So before I get too far into the presentation, it looks like we have quite a few people that have joined. Let's take a look at that list. I see Bob and Monica are on, Dave, Elaine, Elizabeth, John, along with Joe and Robin and Susan as well. If everyone can hear me okay, can they just say so in the chat function? If you could bring that up, that would be really helpful. Let me know that you can hear me okay, and we'll get started here in just a moment. Okay, I'm getting lots of loud and clears. So we will jump right into the presentation. Those are my beautiful kids, but that's not the presentation today. Let me switch these over. So as I mentioned, today's presentation is Building Blocks for a Successful Year. Yesterday, I was looking back through my Strava app. So I like running a lot, and I look back periodically to see my stats because, well, I'm a data-driven person. I like looking at data and trying to learn something from it there. So I was looking back at my runs over the last month or so, and I had noticed one run in particular I did a lot faster. And you might say, okay, Josh, I hear you, but what the heck does you in a Santa suit on a beach have to do with that? Well, when unpacking our holiday decorations at the beginning of December this year, I came across this Santa suit, and I decided, hey, you know what? Since we're going to stay home for the holidays, I know a lot of other people are doing the same, and the holiday season was a little bit disrupted for most of us. Not quite the same as it normally would be. So I thought, you know what? I'm going to go for my 3-mile run around the neighborhood wearing a Santa suit, and hopefully that'll bring some joy to some individuals. So sure enough, on Christmas Eve, whenever I did so, I got lots of smiles, people waving from their cars. I also had a few, moms driving the car and waving to the kids in the back seat. Hey, look, there's Santa. And as I was running by the railroad tracks by our house, there's a little station there. And in that station, a guy sits, and I think his job is just kind of to monitor the tracks, maybe look at the crossing nearby and the swing bridge. But I would have to assume it's kind of a boring job. And I run by it at least 2 times a week, sometimes 3 times a week, and I always see the guy in there. But when I was running by in the Santa suit, he came out with a big smile on his face, waving, and said, "Merry Christmas, Santa." And really, for the rest of my run, it kind of gave me a smile, thinking, maybe I brought this gentleman some extra joy in a time when I'm sure he'd rather be with his family or not sitting in a cold booth on a holiday. So I wanted to share that story because I think even when it's cold out or maybe a little bit unpleasant, if we're happy, we can make the best of situations. Now, whenever I was looking at my runs, I noticed that this was my fastest run in the whole last month. So to me, that tells me, hey, you know what, Josh, if you're happy and kind of excited about what you're doing a little bit more than normal, you'll perform even better. So that's kind of a theme that I want to bring through our presentation today, in that we want to have a positive outlook even in these challenging times. I put the disclaimer up here. I'll give everyone 5 seconds to read through it all. I think we're all on the same page here. What this disclaimer says, in all seriousness, is even if we talk about taxes, Social Security, that doesn't mean that we're affiliated with Social Security or the IRS. We are not CPAs or attorneys. We are financial advisors and financial planners. We help people transition to retirement and have success in retirement. Today, we'll talk about a couple different subjects here, but I always want to keep the big view. So we feel that a comprehensive retirement plan covers 5 different areas. So not only investments or income, but we're also going to think about things like taxes, our legacy plan, and also our health plan to make sure that everything is working together and we don't make a mistake in our investment plan that causes us undue tax consequences or additional health costs. So we like to keep that all in perspective. Over the next 30 minutes here, I'm going to cover 3 different topics. The first one is going to be, let's define what we want from 2021. And the second one is going to be, how much do we need to have what we want in 2021? And then we'll talk about some opportunity and risk that we see in 2021 to make sure we're making the most out of it. New thing for this year we're doing is anyone that participates in the webinar and completes the webinar feedback form that I have here, I will also have that emailed to everyone in attendance as well. If you also schedule a 15-minute call with me afterwards or one of our team members, that will get you a second entry, but we'll be drawing for this $25 gift card. And this is something we're going to do with our monthly webinars. We just want to encourage you to be a little bit more engaged and give me some helpful feedback so I can make sure that these events are as good as possible for everyone in attendance. So this month we'll be giving away a $25 gift card. So at the end of this event, I'll send the links to everyone in chat as well. I just sent the form there that you can fill out, and there's a link for that 15-minute call in that form as well. If you complete that form, again, that's 1 entry, and schedule a 15-minute call, that will be your second entry. Now on this call today, we have some clients and some people that are not yet clients that have attended events in the past or signed up for one of our email lists. It doesn't matter if you're a client or maybe a potential client in the future. This 15-minute call is for everyone. We want to make sure that everyone feels comfortable, as comfortable as you can this year, and get you on a good path to move forward. So let's jump in to the real material here. First area we're going to talk about is let's define what we want. So I thought a quote from Dr. Martin Luther King Jr. would be a good way to start out today. If you can't fly, then run. If you can't run, then walk. If you can't walk, then crawl. But whatever you do, you have to keep moving forward. And I think that that is something that for many people has been a struggle over the last 12 months. With all the very, very quick changes that we've experienced in life can often drag us down and make us feel exhausted. But we got to keep moving forward and keep a positive mindset as much as we can. Now, I know that we are well over half into January, so I hope whatever goals or New Year's resolutions you haven't already been thrown out the window. But if you didn't do an exercise there, we'll talk about some different ways to set goals in 2021. For me personally, it's an exercise that I always like to do to make sure that I'm staying on track for my long-term goals. Again, a goal without a plan is just a wish. So let's come up with a plan for it. Now, this pile of Post-it notes can look like my desk at times. Sometimes I tend to overwhelm myself by trying to commit to too much. So we always need to zero back in and focus on what's most important to us. One method that I use that's very common for setting goals is the SMART technique. So these are specific, measurable, achievable, realistic, and timely goals. So specific. A goal to save more money in 2021 or be healthier or spend less is not very specific. If we want to save more money, does that mean contributing more to a 401k or putting more in short-term savings? And more, again, is not very specific. So is the goal to have $10,000 in savings by June? That would be a specific goal. A measurable goal. So again, here we want it to be quantifiable. How can we track our process and how can we know when we achieve that? If it's to save more, well, that's sort of a lifetime goal or a goal until retirement, at least for most people. We want to always be saving more potentially, but how do we know that we got there? So let's set a benchmark, let's track that progress, and let's make sure that we know when we do succeed. Another key part in the SMART planning arena is achievable. Let's make sure it's a possible goal. If my goal was to become a billionaire this year, I don't think that's really achievable unless I'm really lucky. On the path we're on, I don't think that that's achievable, but that's not my main goal. My main goal is to make sure that we have financial security in our family. So how can I, again, track that? Is it achievable? And do we know when we succeed? Realistic. So the R in SMART stands for realistic. Is it an appropriate goal? And this is something that I always refocus on. For me, about 4 years back, I did some long-term planning and said, you know, what's really the most important to me? Still a pretty young guy. Where do I see my life and what gives me the most satisfaction? So I set 3 core goals for my life. And the first one is to be the best father. I have 2 young boys. I want to make sure that I'm raising them right and make sure that they are healthy, happy, and productive individuals as they grow older. My second goal is be the best husband. So make sure that I'm being good to my wife and maintaining our relationship. For us, at times, this has been difficult over the last year as we're pulled in so many directions and, you know, increased needs for us to be with our kids and trying to work at the same time, like many families. And then my third overall goal is to be the best financial advisor and best financial planner. So that means constantly learning more and making sure that I'm engaging with people in different ways. So when I look at my goals for a year like 2020, I need to say, are they appropriate? Are they realistic? Do they keep me in this realm of what I want to do in the long term? And will it help me improve my life? The T stands for timely or time bound. So how long, how often do we need to do this? We need to have a defined endpoint and a clear target. So the first action, so if you want to schedule a 15-minute call, will be schedule a goal planning session. For most of you that are clients, when we met with you, we talked about, hey, what are your goals? And that could be, hey, to retire in 5 years. Well, maybe that's changed. Maybe with all the disruptions of last year, you now want to retire in, you know, mid next year. So let's adjust your plan to do so. It might be, well, hey, you know what? I'm sick of being locked up and not seeing my family. So let's plan a goal of taking the family on a big vacation. This is a goal for Yana and I. We want to take a nice vacation together and have a little bit of time to spend one-on-one with each other. So we're planning that for the end of next year, you know, with the assumption that everything will be cleared up. So we are making sure that we're saving money along the way and checking off the check marks to make sure that that goal is achievable. So if you want to revisit your goals, schedule that 15-minute call. I will make a copy of this link here and send it in chat as well. To make sure that everyone can access that. Bear with me for one moment. Okay, I just sent that link in chat as well. So make sure that you schedule a 15-minute call. We can update your goals, or if you haven't gone through a goal planning exercise with us yet, we'd be happy to do so with you. Second area that I wanted to cover today is how much do we need? It's a pretty basic question. Let's start it out with, what do we spend on a monthly basis? I just see someone said that they didn't see it in chat. Let me resend that here. Susan, if you could reply in chat and let me see that you did see it there. I will also resend that form to make sure everyone has it as well. If anyone has any questions too, Susan just took advantage of this, but there is a question and answer area. I'll do my best to kind of answer them along the way or at the conclusion of this event, or I'll email you one-on-one. So if anyone has any questions, feel free to put it in chat or in the question and answer section. So moving on, what do you spend on a monthly basis? While this might seem like a basic question, too many times we meet with individuals and they say, oh, I only spend a blank amount per month. But when we look at how much money they have coming in and what they're saving and take out things like taxes as well, there seems to be a disconnect there. So let's get a real idea of what we need on a monthly basis, and also what we have coming in. Now, we all wish that we were as young as this handsome little guy in the picture here with this big fat stack of money, but that's not the case for everyone. Typically, we have constraints that we need to work within, and we also have a shorter period of time to achieve those as well. So moving forward, if you haven't done our budget worksheet, this is a good starting point. So we can write down a lot of those basic expenses that we have. If anyone wants a copy of this to redo the exercise or to do it for the first time, feel free to let me know in chat, and I'll make sure to send that out to you at the end of this workshop. If you go through, you can look through your expenses from last year and mark things down. We can use that to plug into your plan and take a better look at how much you'll actually need. Another piece of budgeting that we often overlook. I'm a data guy, so I like to say, okay, this is how much you spend, this is what you need, and that's easy. But another piece that we need to look at is, are we spending money appropriately? Sometimes we waste money on things that we don't really need or we don't desire to have. So when reviewing a budget, Yana and I like to think, what's most important to us? You know, is it family, faith, knowledge, love, nature, achievement, or tradition? And this year in playing Legos with my two boys, I thought, hey, here's a different way to look at it. Maybe we can visualize our budget by taking some of these Legos and making stacks to represent those dollar amounts. So by looking at, hey, visually, this is where we're spending our money. Does that align with our values and goals? Now, of course, with two young boys, we spend an awful lot of money on household items, food, clothing, daycare as well. But you know what? That's a very important thing to us. One of our most important things as a family is family. We like to spend time with family and be able to do so. So that's okay. If that's a taller stack than other things, that's perfectly fine as well. So if you want to go through a budget process with us, we'll be happy to help you visualize it. So take a look at it in a different way. I actually have a whole bag of Legos here that we used, and I've used with a few clients to help them visualize their budget. This can be a great way to reduce some expenses in areas that you want to realign with your values. So again, if you want a copy of that budget sheet, or if you just want to schedule a session to talk more about budgeting and ways that you could kind of refocus your spending, we'd be happy to do so. So that's action number 2. Again, you can use that same link, and I'll send it out here in chat again for everyone. Schedule that 15-minute call. If it takes longer than that, that is perfectly fine as well. I've blocked off more time in between those slots. So once you schedule, we can spend more time on it if necessary, or schedule a follow-up appointment. But again, the main goal of budgeting is not to know exactly every penny that you spend, but know that we can balance out our needs and wants to get what makes us the most happy over time. Third area, and this one's going to be the longest, so I see I'm about 20 minutes in. I might run a little bit over, but this is opportunities and risks in 2021. There's a couple slides that I shared in last month's webinar that I want to revisit. We now know that the Democrats will have a majority in the Senate, the House, and of course in the presidency as well. From President Biden's agenda, from some of our partners that help us navigate this political arena in regards to the market, we looked at some of the pieces of the agenda that we think might actually come to fruition. So the first one off the bat here would be another pandemic relief bill. This is already being talked about. It's pretty mainstream news. Nothing really changed here. The other idea is that it's going to be combined with infrastructure and manufacturing investment as well. You know, in many client emails and phone calls that I've had over the past few months, of course, there's concern about a new administration and you know, if this is going to hurt the market. I think the market will be watching closely, but right off the bat, if we have additional stimulus, it's going to be more money in the pockets of individuals. So I think that that'll help keep the market stable for the time being. We'll also look, if there's any more Supreme Court nominees come up, they'll be looking to confirm those as well as additional judges as well, just as the Trump administration did as well. We'll see that further scrutiny on big tech, which might have a negative effect on some of those stocks in the short term as well, and continued strain with US and China relations. We're going to keep an eye out on the tax bill. So that might mean repealing the Tax Cuts and Jobs Act of 2017. One of the things that we're looking forward to is hopefully re-engaging with allies, having some better relations with some nations that we had more strained relations over the past couple of years. Some of those things might include tax treaties as well. So we are looking for possible additional college funding too. So looking at possibilities for community college to be debt-free. One of the programs that I learned recently about in Michigan here is they have a 3-2 program in high school where you can go to high school for 5 years, and that's included in your taxpayer money. And at the end of that 5-year time period, you would actually have an associate's degree. So they're partnering with the local community college, which really provides additional education to a lot more people included in their taxpayer dollars already. So I thought that that was kind of a creative way to address this issue, to make sure that more individuals are getting higher education. What we don't see happen in President Biden's agenda is this talk of pairing cap gains and dividends rates with your regular earned income or the regular tax brackets. We don't really see that happening, or the loss of a step up in basis at death. So if you own a stock in an after-tax account, that stock, when you pass away, could pass on to your kids. And when they receive that stock, the date of your death, the tax basis is reset at the price on that day. So if you have really large stock gains, those might be good stocks to hold for your legacy. That's been a huge advantage for individuals over a long period of time. We don't really see that going away. One of the things that I personally want to keep a close eye on that might have a lot of effect on some of you that are thinking about retiring prior to age 65 is lowering the Medicare eligibility age to 60. This would give a lot of flexibility. Oftentimes retiring prior to age 65, one of the biggest concerns that we frequently hear is, well, I can't get on Medicare and individual insurance is so expensive. So there are some tricks to the trade around that. If you have concerns or questions around that, again, if you schedule that 15-minute call, I'd be happy to address those with you. There are some planning techniques in there, but in general, that might be a way to provide more accessibility to individuals moving forward. We might see some Social Security reform as well, along with student loan forgiveness. We might see the lifetime gifting limit be lowered to $1 million as well. This is another piece that I had in last month's presentation that I wanted to bring back again. In many conversations since then that I've had with individuals, we talked about top tax rates and the average rates that Americans are paying. This is a big concern with the new administration. Many people are worried that we're going to be in such a high tax environment that it might drastically affect their retirement. So I went back to 1979 through the end of 2017, and I looked at the top tax rate, which in 1979 was 70%, which some proposals have called for again. Even when that top tax rate was 70%, the average American was only paying slightly over 20% taxes. This red line represents the average tax rates for Americans. We can see it's somewhat stable. It hovers right around 20%, a little above. If we look at times like 2008, 2009, when people were earning less money, it dipped down below, but overall it's fairly stable even when this top tax rate is jumping up and down. Then I threw one additional layer on it and I said, well, what about the top 1%? So those really high income individuals that represent the top 1% of income earners in the United States. And I laid that on the same graph here with this green line. And we can see even for those individuals, the tax rate has really not jumped that drastically. It was right around 35%. The average rate for that top 1% when the top tax bracket was 70%. And it's had a little bit more variation than the average rate overall. But again, we're not seeing these drastic jumps up and down. And a big reason for that is, well, if you're making that much money, you can hire a really good CPA that'll find ways to help you keep your tax rates lower. And that's what we've seen over time. So I don't see this as a gigantic risk. What I do see is that the government is spending a lot of money, and at some point we are going to have to pay the bill for it. So I think, at bare minimum in 2025, we'll see the end of the Tax Cuts and Jobs Act personal tax rate deductions, and we'll go back to our old tax brackets at that time. So for the average individual, that might represent a 3% tax raise. I think that's what most of you on the webinar today should expect is sometime in the future, it might be a year from now, or in 4 years from now, we'll see those tax rates go a little bit higher. Other areas I wanted to touch on again is savings rates are still ultra low. They tend to keep clicking lower, and the average savings rate is 0.05%. There are some savings accounts paying around 0.5% now, but for the most part, all savings rates are extremely low. Same thing with bond rates. If we look at a 30-year government treasury, the yield is 1.34%. So if we tie our money up in a safe fashion, for 30 years, we get paid 1.34%. That's not really enough for most of the clients that we work with. It's okay for short-term money. If we can put some money in savings that we might spend over the next group of years, that's okay. So one of the conversations I wanted to bring up and one of the opportunities that we see for individuals is to get a little bit higher of a savings rate. So sort of the migration from a savings account, the next step up would be a CD. So if we look at CD rates, I pulled these this morning from bankrate.com, but we have a 3-year CD rate at 0.85, 4-year at 0.9, and a 5-year at 1%. Now, a CD alternative that we've been using for many years with a lot of our clients is a multi-year guaranteed annuity. So here, over the same duration, over a 3-year time period, we'd have a 2.4% interest rate, and that's guaranteed over that 3-year time period. Over the 4-year time period, it's quite a bit higher again at 2.6, and over the 5-year time period, we could earn a 3% rate. So what I would say here is, hey, if you're thinking about retiring soon, or you just like having a lot of money in savings, but you're worried that you're not earning enough now, let's take a portion of that and maybe look at a 3-year multi-year guaranteed annuity where we can earn a little bit more than we are in the bank account, so about 2.4%. That way we're continuing to grow the money over time. So that's one little opportunity that we've seen that I want you all to be aware of, because many times people just say, yeah, well, I can't earn anything in safe money today. And while that is certainly true in many regards, this is one of the best opportunities that we see in this ultra low interest rate environment. Pulled this quote out of something that I was reading recently, but it says, for reasons I've never understood, people like to hear that the world is going to hell. So, if we watch the news, all we constantly hear is negative things. So, the whole world's ending, our democracy's falling apart. And while things certainly have been challenging over the last 12 months, I don't know that it's the end of the world. So I pulled out 3 graphs that tell me some good news from 2020. The first one here is personal income actually went up. So if we look, personal income in trillions went up over this time period. We can see a correlation right here with some of the stimulus money that went in. But hey, you know what? Good news is good news. More money in individuals' pockets is always good news. Another piece of good news here is that debt, so individual debt, household debt, service payments as a share of income. So how much are you paying down debt as a portion of your income also went down, which is a good news. It's a good piece in 2020 as well. So we can see here, really this peaked pretty high in 2008 and it started to decline at that point, but we had another pretty rapid drop off here in 2020 as well. So I'll say that's good news as well. And the last one here is that the personal savings rate skyrocketed. We really saw a drastic jump. Again, this is really closely corresponding with those stimulus payments. But even when we drop back down, we're still above where we were. So people are saving more money. That's good. That means as the economy opens back up, they'll hopefully go out and spend some of that money on enjoyable things like traveling or things that we haven't been able to do. Always like to share this graph. This Morningstar puts this together. You know, they update it frequently, but this shows us stock returns over the long term. So here I want to say, tune out the noise. So there's a lot of noise. If we're invested, we're focused on the long term. We know in any 1 year time period, we have a 27% chance of having less money than we started with, and a 73% chance of having more. So this goes all the way back to 1926. If we take that out over a 5 year time span, our chance of loss over that 5 year time period goes down to 13%. If we look over that 5 year time period, our chance of a gain is 87%. And when we look out over a longer time horizon, 15 years, we can see it's 100% that the market's been out. That's no guarantee that it'll continue to do so in the future. But long-term trends is that if we're invested and patient over the long term, we'll continue to gain more money. So you might be thinking, hey, 15 years sounds like a long time, Josh. I don't know that I have that much time left. I'm retiring, or I just retired. Well, if you're 65 today, 65 plus 15, well, my 93-year-old grandmother would tell you, hey, you better plan for a long life. So we want to make sure that we're investing funds for the long term as well. So this is where we balance out things like that multi-year guaranteed annuity, the short-term fixed rate with long-term investments as well. Another area of opportunity that we see is that some of these unpopular sectors might outperform moving forward. So this graph here shows international versus domestic equities. So US stocks versus international stocks. And we can see over this last 10-year time period, international stocks have underperformed domestic stocks by over 5%. We can see that this also happened in 1989 through 1999, throughout that decade. Similar trend here, but in between it flipped. We actually had outperformance of about 5% with those international stocks when US equities tended to be flat over that time period. So what this tells us is, hey, let's be careful. Let's not say, hey, just because this sector is done well, we're going to assume that that's the same piece moving forward. Another question that I often get, though, is the S&P overvalued? Well, I would like to say that the market over the long term actually does a great job of valuing itself. Over the short term, we can have deviations, but over the long term, it tends to work out. So again, we need to go back to those timelines. Do we have an appropriate timeline for our investment plan? If you have questions on that, schedule the 15-minute call. We'll talk through it and make sure that your investment plan meets up with your timelines there as well. So what this graph here shows is inflation going back to 1880, stacked on top with dividends and buybacks. So dividends are when you own a stock and the company returns some of the profit to you via a dividend, or a stock buyback, which has become more popular over the last 15 years, where companies like Berkshire Hathaway will say, hey, we have extra money on the balance sheet. What's our best use of it? Well, we see it as buying back some of the stock, which also acts like a dividend because it's reducing the number of publicly outstanding shares. The next piece layered on top here is cash flow growth. So what's the actual amount of cash flow growth in those companies? We can see over the long term here, inflation's been 2.1, dividends and buybacks make up for about 5%, and cash flow growth at 1.9. So the fundamental return, if we just add up those three pieces, is 8.8%, and the actual S&P 500 return over this time period is 9.1. So, hey, you know what? The actual price return represents fundamentals pretty well. Next piece I want to follow up with is a common question that I get is, should I buy gold or Bitcoin? I would say that both tend to be out of our normal realm. Bitcoin is a new technology that has been paired with currency. Bitcoin is ultra volatile. It goes up and down very quickly in price and changes price constantly. So it's not stable. So they'll say it's a cryptocurrency, it's decentralized, it's a trust-based system. All that can be true, but should you put your whole retirement in it? Probably not, even if it's done really well in the short term. If you're worried about the market, many times we'll hear, oh, I'm worried about the market. I'm worried about the stability of the US dollar. I want to buy gold. Well, certainly that could be a thing, or that could be a way to mitigate some of those risks. But I would also say that if the US currency fails, a bar of gold in your pocket is not going to be the most helpful thing as well. If you really are intrigued or want to invest in these areas, we're going to apply what we call the 10% allocation rule. Never put more than 10% into one individual investment. Two examples that I have up here are GE and Enron. Enron was a fantastic company to own until we found out that they weren't really keeping the books too well. GE, well, kind of similar story, not blatant fraud, but the way that they moved money around certain entities to meet analysts' expectations made the stock become so ultra overvalued and had a lot of debt shifting around within the company that then caused the stock price to fall very quickly. So we don't want to be over invested in one area. When we think about things like gold or Bitcoin too, these assets don't have the same sort of fundamental return that we can calculate with a stock. So for me, it's cognitively, it's a harder thing to own and to value appropriately. So I would place caution there as well. Gold is a raw material that we have. So it's really more of a supply and demand. There is no going to be cash flow growth in it. There is going to be no dividends and buybacks from that asset. Similar to Bitcoin as well. So another piece that I wanted to put up that came from Morningstar recently talks about diversification here as well. So this sticks with that 10% rule where we don't want to own more than 10% in one individual stock or asset. So here we're looking at top performers in individual years going all the way back to 2007. Which I guess isn't that long, but over this time period, we can see US equity or US stocks was not the top performer in every single year. We could see in 2019, well, it was the top performer then. And this chart goes to September of 2020, but it was the top performer there as well. We can see that the bottom performer here is UK equity. So the United Kingdom, the stocks there actually got hit the hardest. What I'm going for here is that, hey, you know what? Maybe since US stocks have been on a run lately, maybe we need to diversify and make sure that some of these losers that might become winners again, like US stocks did after 2008, were participating in those gains as well. We can see here in 2008 as well, emerging market equities had the biggest loss, over 50%. But they followed up the next year with an 83% gain. So we want to stay diversified in our portfolio. When we look at these sorts of returns, we can say, hey, well, that varies even more than we saw in the US stock market, which caused a lot of panic. So we don't want to be over-invested in one sector or the other where we experience too much pain, but certainly we want to make sure that we're taking advantage of all areas of the market. Just wanted to touch base with our bucket approach. So at the Leonard Advisory Group, we don't believe that everything needs to be in tech startup stocks or everything needs to be hidden under the mattress at home. We take a bucketed approach where we keep some money in protected income. This is going to be our safe money. It's going to keep up with inflation over the time, but it's not going to be growing like those tech stocks. Our next bucket here, our income-based bucket, is going to be things like dividend-paying stocks and bonds, or things that give us a yield or some income for holding them over time. And our most aggressive, or our third bucket, is going to be our growth bucket. This bucket is going to be where we're owning those growth-based stocks, maybe like Amazon, where they're taking the profits from the company and reinvesting them to continue growing the company over time. So we don't advocate putting anything in one place or the other. Rather, we take a blended approach based off of your risk. So our third action for today is going to be to do risk analysis. If you've done one of these with us before, I encourage you to do it again. Maybe it's been a few years since you did it, and maybe you're thinking about risk a little bit differently, or maybe other pieces of your plan have changed, which means, hey, I want to be a little bit more conservative, or maybe I want to be more aggressive. So I encourage you to do that risk analysis, even if you've done it in the past. If you haven't been through our risk analysis process, it's pretty good. We take a look at all of your assets and tell you, hey, if 2008 happened again, or even March of last year, this is how much we would see your portfolio decline, and this is how long it would take to recover. And these are the average rates of return we'd expect moving forward for the risk that you're taking. And then we can have a conversation. Does it make sense to reallocate to a lower risk profile, or can we just be more efficient within the risk profile that we're in? Can we get a higher rate of return by diversifying further? So I encourage you to take advantage of the risk analysis as well. Now, if we get to this point in the discussion and you say, hey, Josh, you know what? I kind of want to do all three things. Just schedule the 15-minute phone call. It'll be way too much to cover in 15 minutes. And if Tom's on today, he'll let me know that I can't do that in 15 minutes like he did on last month's webinar. But I'll expand time appropriately. When you schedule the 15-minute call, just note the topics that you want to cover, and I can expand the appointment based on that. So again, I encourage you to take advantage of it. Again, we talked about 3 different pieces today, but comprehensive retirement plan is not just your income or tax or investment plan. It's all 5 pieces. So when we make decisions, we want them to be rooted in all 5 areas of your retirement. Last month, I shared a picture of a local photographer here in Michigan as well. But this is the St. Joseph Lighthouse, and this is a picture from March of last year where we see a surfer surfing on Lake Michigan. And I love these pictures. I love seeing people out there surfing. I know that the water's freezing cold, and for most of us, they seem like a bunch of lunatics, but you know what? They're making the most of the rough conditions and dealing with the local environment and making the most out of it. None of these guys are forced to do it. They're certainly doing it out of their own joy. So just like my cold run in a Santa suit where I needed to fix my beard the whole time, hey, let's make the most out of these rough conditions. So let's set some goals. Let's know what risks we're under, and let's plan appropriately to make sure that we're making the most out of these challenging times. Again, wanted to remind everyone, by completing the feedback form, that I will send a copy of that link out in chat again as well. By completing that form, you'll be entered to win a $25 Amazon gift card. You will also, here we go. You'll also be, you can also gain a second entry to win the gift card by scheduling a 15-minute phone call for any of those actions that we discussed throughout the webinar today. Or if you have any other questions, schedule that call and that'll place you in for a second opportunity to win the gift card. I will be raffling that off on the 29th of January. Whoever wins that gift card, I'll give you a call to let you know, or Desiree or someone from our office will, and you'll be emailed a link to access that $25 gift card. I thank everyone for attending today. I hope you found it useful, and hopefully in running through some of these exercises, it gave you some new perspective on this year, and look forward to talking with you all in that 15-minute phone call over the next couple weeks. Have a wonderful day.